It is estimated that 7 trillion to 32 trillion US is held privately via offshore accounts. To put this in context, the US had a GDP in 2017 of 19.39 trillion. The UK had a GDP in 2017 of 2.622 trillion. The US decided to combat this with FATCA. FATCA forces non-US reporting financial institutions to report US account holders and US account holders of what the layperson may call a shell company. In addition, FATCA enforces non-US reporting financial institutions to apply a FATCA withholding penalty tax on account holders who have a FATCA status of either a recalcitrant account holder or a non-participating foreign financial institution. The deadline for allocating a FATCA status to all customers' financial accounts was 2016. Non-US financial institutions face being classified as non-participating financial institutions if they did not comply. Hence, they would have faced a 30% FATCA withholding tax penalty on all US income and, in time, all US gross proceeds. 113 tax jurisdictions agreed to impose FATCA on their own financial institutions by enshrining FATCA into local law. The first non-US tax jurisdiction to agree such an approach with the US Treasury, now known as the Inter Governmental Agreements, was the UK. The type of IGA they entered into was a Model 1A IGA. The EU G5, which included the UK, agreed to share information between themselves and recommended this approach, minus FATCA withholding, to the OECD. The OECD agreed to this approach under what is called the Automatic Exchange of Information, AEOI. The Automatic Exchange of Information consists of the CRS, Common Reporting Standard, and the MCAA, the Multilateral Competent Authority Agreement. In the European Union, the EU adopted the AEOI via DAC 2. DAC 2 essentially strips the European Savings Directive out and implements the Common Reporting Standard. Under the CRS, the deadline for allocating a CRS status to every customer's financial account is 2 years after commencement of the regime. Hence, an early adopter commences the CRS from the 1st of January 2016 and has until the 31st of December 2017. Neither FATCA nor CRS allow new-to-bank customers to open a financial account without a FATCA status, CRS status, establishing whether the account holder has US citizenship for tax purposes, all of the tax residencies of the account holder, and all of the above for controlling persons of passive non-financial entities, what a layperson might consider to be a potential shell corporation. In some circumstances, up to 90 days are allowed to determine these statuses. IGAs and FATCA withholding. Inside or outside of an IGA, FATCA withholding only applies to either non-participating foreign financial institutions, and by foreign in the context of FATCA we mean non-US, or recalcitrant account holders. In IGA tax jurisdictions, FATCA withholding does not apply to recalcitrant account holders provided that they are reported as recalcitrant account holders, which of course first requires applying the FATCA status of recalcitrant account holder to the customer's financial account. The FATCA reporting treatment and FATCA withholding treatment is always determined by the FATCA status applied to the customer's financial account. The FATCA status of NPFFI, or non-participating foreign financial institution, requires a period of significant non-compliance that has been recognised by the host country tax authority and unresolved over a period that varies between 12 to 18 months, depending on the tax jurisdiction. Hence, a genuine NPFFI status in an IJ country would be extraordinary. An FI could not, in an IJ tax jurisdiction, declare itself an NPFFI because this would be tantamount to declaring an intention not to comply with the laws of that local tax jurisdiction. A non-US financial institution in an IJ tax jurisdiction is not an NPFFI simply because it has failed to self-certify or supply a valid GIN. There are, however, nuances, and I shall explain those shortly. Hence, the IGAs all but negate FATCA penalty withholding under an IGA by making the status of NPFFI extraordinary by being conditional upon significant non-compliance as defined in the IGA, typically IGA Article 5, Section 2. Undocumented accounts. Despite the 2016 deadline to classify customer financial accounts Many financial institutions have failed with regards to their obligation to apply FATCA status to their customers' financial accounts. These accounts remain undocumented for FATCA purposes. The same is true for the CRS. The deadline is different, but the deadline has been missed. Hence, the reporting regimes that FATCA and CRS have, at present, failed to address the $7 trillion to $32 trillion elephant in the room. A significant volume of material customer financial accounts have not been reported because they have not yet been classified with the reportable FATCA status or reportable CRS status.